All right. So I'll start this off with a question to the audience and actually an interesting fact that I learned today. Did you know that we saw 40% fewer funds formed in 2022 compared to 2021, but fund managers today are still anticipating reaching their fundraising targets? So that was something interesting that I learned today. And we'll actually have some more really interesting statistics coming from Passthrough's new State of Fundraising report. So actually, Tim and Ben and the Passthrough team had just released their new State of Fundraising report, which was perfect timing for this webinar. They served 100 GPs about the challenging fundraising conditions across private markets. And we'll touch on that more in just a moment. But before we dive in, I wanted to thank everyone for joining. This is our second session in our Essential Fund Launch webinar series. My name is Emma Summers. I am the Director of Business Development here at Vector. And I'm super excited to have Tim, Flannery, and Ben Doran here, co-founders of Passthrough. I'm sure if you're joining, you probably know who Passthrough is, but I'm super excited to have them here as our guest speakers. Just a little bit about Vector. We are a premier fund administrator focused on closed-ended alternative investment vehicles. So we basically do all the back office support for funds and SPVs. And this is actually the first part of a two-part webinar series or webinar session that we're doing with Passthrough. And by the end of today's session, you're going to walk away with some really interesting statistics, key points of the state of fundraising right now. And then we're also going to be discussing about how the closing process works when you actually get to the end of fundraising. And then I'll talk about the second session that we're doing with Passthrough at the end of this. So similar to the last session, if you joined, we'll be spending 45 minutes chatting through some questions. So I have a list of some really great questions that I'm going to ask Tim and Ben. And then we'll spend 15 minutes at the end asking Ben and Tim any of the questions that you might have in the audience. So on the bottom right-hand corner of the screen, you should be able to see a questions option where you can submit those questions. You can do that at any point in time in the webinar, and then we'll visit those, within the last 15 minutes. And then we are also recording this webinar, so I'll share this after the session with some follow-up links to the next one and some information that we'll take away from this session today. Tim, Ben, thank you again. I'd love if you could introduce yourself and then tell us a little bit about Passthrough, and we can kick things off.
Great. I'm Tim. I'm one of the co-founders and CEO of Passthrough. And yeah, we make it very simple for your investors to invest into your funds. We handle solely the investor onboarding piece of this. And that's why we work with great partners like Vector, who handle all of the other dirty work that comes out there. So that means electronic subscription documents and KYC AML. In fact, we'll even give you recommendations on the risks of your investors. And so we can help you manage your risk on an ongoing basis too. So that's me in a nutshell. Ben.
Hey, I'm Ben, Tim's co-founder. I lead our product and operations here at Passthrough. I think Tim did a nice job of explaining what we do, but that's me.
Awesome. Well, thank you both so much. Really excited to have you here today. We'll start off with the questions. And I love starting with a broad question. So I think I'm going to continue doing this with all the webinars. So I guess this first one's for you, Tim. How would you describe the current state of fundraising in the venture capital industry?
Well, so the way that others have described it is that it's pretty rough out there. So you mentioned it at the top, but we went out and we surveyed around 100 fund managers. And when we asked them whether they thought it was very easy, challenging, quite challenging, 80% of fund managers said that today was a difficult environment. And so that's either challenging or extremely challenging. But when you take a look at that, you can see it reflected in the number of funds formed last year. But when you match it to what their expectations are for what they're going to be able to do on their current raises, 80% of managers are still confident they're going to be able to go out and still hit or exceed their targets, which is a little bit tough to square those two originally. Part of it, though, is based on their views of the macro environment. So almost 7 out of 10 fund managers expect the macro environment to improve in the next 12 months. 20% of all the fund managers surveyed expected it's going to change dramatically. So part of it is, yes, the world is getting better, but also, I'm sure we'll talk about it a little bit later, everybody's pulling out all of the stops. And so when they're pulling out all of the stops, when they see that the world's getting better, they suspect that they're going to be able to go and hit their targets. So even if that is the case, though, we still have seen a little bit of a shrink in the space. But when we take a look at the long-term trends here, everything still is quite favorable. PwC just released a report recently. The alternative space at large is about $18 trillion today, and they still see it growing about 5 to 7% annually over the next few years. That it will be about a $24 trillion industry, and obviously venture plays a very important role in it. A lot of the growth that we're seeing in this is really tied to the retail side, believe it or not. This isn't maybe the most surprising development for venture funds. I think venture funds were pretty quick actually to understand that there's a lot of opportunities in family office and in retail. But it's not just them, it's the Blackstones, it's the Apollos. Everybody's rushing to retail because retail is responsible for 50% of all of the wealth in the country, yet it's only responsible for about 16% of the wealth that's in alternative assets. And so it's hard out there, but people are working pretty hard and still believe that they're going to be able to go achieve their targets based on macro, but also just based on their own ability to overachieve.
Awesome. Yeah, it definitely sounds like, one, those are some super interesting statistics, and that there is a silver lining with like all of the state of fundraising right now. And you know what, we'll share a link to that state of fundraising report after in the follow-up. So we'll share the page where you can go and download it, because I think that's going to have some great information that I'm sure a lot of the audience would love to see. So moving on to some trends, what do you see, or what are you seeing in terms of fundraising strategies and investor preferences?
Yeah, GPs are saying it's tougher to bring new investors in. It's even tougher to get existing investors to re-up. Operational due diligence requirements are only getting tougher, and so the response is that they're getting scrappier. And so we actually see it reflected in the data on Passthrough. We're seeing that people are actually going through more frequent closes. We're seeing it impact the way that fund managers think about their investor base composition. Pretty much all of the fund managers that we spoke to said that they were either going to add more international investors, they were going to add more family offices, institutions, retail. The constant there was change. And on that international piece, yeah, they're moving into new regions. We're seeing that there's actually a pretty big push to Asia, and the Middle East has been pretty well talked about at this point, I think. We're seeing there's still a strong focus on ESG, and we weren't sure how this was going to play out. We couldn't tell if it was something that was just politicized today, and that's just a part of what the dialogue was. But actually, about 3/4 of the fund managers we surveyed said that ESG was going to continue to be an important part of how investors were evaluating them over the next year. We also saw that this changed people's cash management strategies, and part of this is how they're pitching to their LPs. There's a heavier reliance on capital call lines over the last 6 months, and that's true even with the regional banking crisis that we've seen too. So those are some of like the broad trends, but the way that we're seeing this play out is, first of all, people are adding placement agents at a pretty good clip. So they're either adding them for their first time or they're adding to the roster. Part of this is to help them expand into new regions. Part of it is because they are trying to get to new different groups of investors that perhaps weren't where they focused on building relationships in the past. We're also seeing a pretty big change in the way that people are approaching their brand and communications. I don't know, my personal observation on technology in the investor relations and fundraising function for fund managers, VCs do tend to be on the front edge of this relative to a lot of other spaces, but it's catching up to the things that private companies are used to doing. So stuff like CRMs and email automation that are just table stakes for what private companies are doing are now being adopted in mass by fund managers themselves. But the one that I was a little bit surprised by was actually the AI approach. So I'd heard all sorts of things about how fund managers were using AI to evaluate their portfolio companies, or how it was a part of their strategy, obviously. But we actually saw that around half of all fund managers were using AI to do any one of these things, for data analytics, to actually generate pitch books, to find new investors, to get through operational due diligence. One manager we talked to he was using it to find lookalike investors, generate their contact information, come up with a communication strategy down to the actual content that was going out, and then using it to tweak their pitch based on what the audience was. And so, of course, none of the things that were coming out were fully polished and fully formed and ready to go. But this was a non-technical individual that was doing this so that they could speed up their job and get more leverage out of it. So I thought that was pretty incredible, and just more than I suspected. Brand building's become a pretty big thing, and again, in VC, this for a certain segment of the audience isn't that surprising because everybody's been building their personalities on Twitter or wherever it might be. But it continues to be something where it's a focus on not building generic thought leadership. And comm strategy, I actually think this has been something that's for a long time been a differentiator between firms, and LPs definitely recognize this. We had one fund manager we spoke to where they talked about what happened during the SVB banking crisis, the fact that they were going out that weekend, identifying the total exposure that they as a firm had, that all of their portfolio companies had, calling every single LP saying, here's what we know, here's what we don't know. And so comms has been a really, really important thing for people here. And so all this, even though these are the strategies that people are doing, it's a great time to be an LP. So LPs that are in alternatives that are willing to stay the course. Okay, well, first of all, they're getting access to funds that previously they haven't been able to get access to. They're all asking for liquidity. So about 80% of the GPs that we spoke to said they had LPs knocking on the door and asking for liquidity through secondary transactions on their LP interests. And about half of them were granting it. And so it could be liquidity because they were going to re-up in the next fund, or it could just be general liquidity requests. But yeah, that's a pretty big one. Half of them are offering more favorable terms, and about half of them are also doing co-investment opportunities. So we're just in general, like the economic relationship between GPs and LPs are always in flux. But I think some of the fundamental parts of the relationship between LPs and GPs are beginning to change.
I mean, that's pretty insane to hear about like how the state of fundraising has actually shifted these trends and all the new strategies GPs are doing. And it's also, I've been hearing that too, that it's an opportunistic time to be an LP. And I think that's part of that silver lining that we were talking about. Definitely really interesting to hear about the AI side. I think that is obviously a very new thing. And I am excited, but a little bit scared to see where that goes. I know we're at the very beginning of it, so we'll see. We'll see what the future holds for that. But Ben, the next question is for you. What are some challenges that venture capital firms typically face during the fundraising process?
Yeah, that's a great question. I've worked with probably a few hundred venture capital firms between Passthrough and my prior job, and I participated in an institutional fundraise before that when I was working private equity real estate. I think one of the things that you just have to keep in mind off the top is that it's a sales process. And so a lot of the things that are associated with a good sales process, you have to kind of bring into to the fundraising process. So you have to make sure that you have a really good process. And what that means is you have a timeline. You communicate to people what's going on in terms of when you're going to close, and you have deadlines. Where I've seen fundraising get kind of off track is that if you can't communicate a deadline on when folks need to be in, they'll just kind of delay, and you're not able to close. You need to get a critical mass, and that's kind of the hardest part, is getting the critical mass of folks so you can do your first close. Other things that are common from sales, there's a lot of folks that you can spend a lot of time on, that they ultimately aren't going to invest. So just being able to kind of understand, are these folks kicking the tires or not? We have some information about focusing on the right investor in our emerging managers guide, but making sure that you're focusing on folks who are able to kind of check. And then the other thing is you want to make sure that your fund formation council and your fund admin have worked with emerging managers before and really do it a lot. There's basically there's a lot of folks out there on the fund formation side who have a lot of experience working with emerging managers, and they'll get you kind of the materials you need and everything in place at a reasonable price and make sure everything's kind of buttoned up. Where I've seen folks get in trouble on the legal side is where they use an attorney who maybe they know, and this isn't the primary thing that they're doing, and folks try to reinvent the wheel, and that it looks unprofessional to your investors, and it also you end up getting bad advice. So you need to make sure that your legal counsel, your fund administrators, you have experience in the domain.
Yeah, and that ties it back to the last session we did with DLA Piper, where they talked a lot about working with legal counsel that doesn't necessarily know what they're doing, overcomplication, oversimplification. So you really do have to work with someone who knows what they're doing in the space. And you also touched on the Emerging Manager Guide, and that is a fantastic resource for emerging managers. It really wraps everything into one document. So I will also share a link to download that after. It's really great. You'll want it. We even collabed on a couple pages, so that was super fun. But next question. So are there any notable differences in fundraising strategies and challenges with these first-time fund managers?
Yeah. I mean, so the bad news is that it's very hard to get started as a manager, and the reason is because you don't have a track record, and so it's difficult to get moving. The good news is that if you're able to get over that hump and get going, the life of a fund manager is a nice one once you get fund one kind of rolling. So not having a track record makes it hard. So what sometimes the folks do is they'll have their track record of angel investments that they made. Sometimes folks get started out on an SPV strategy. SPV strategy just means that you're going to form a special purpose vehicle and make individual investments and kind of aggregate investors around individual investments. The hard part about that is you really ultimately want to, there are some groups that have been successful with SPV strategies, but ultimately most folks really want to have a fund because it gives you that base of management fees where you can really build a business and build a structure. So it's hard to differentiate initially when you're a first-time fund manager, primarily because you don't have a track record to rely on.
Mm-hmm.
We've got, and then I can just give you kind of an update. I think Tim touched on this a little bit on some of the data, but what we're seeing now is if you look at like the average number of the average amount of funds that are raised by a first-time fund manager from 2008 to 2021, compare that to what happened in 2022, 2023, the average amount raised is down about 20%.
Wow.
And so your expectations should be that that you're going to probably raise a little bit smaller fund than you would have if you've been raising a few years ago. That said, venture is a competitive market, so there's less money out there. For everyone, the value of companies will go down, and you'll be able to maintain your position. And then, as far as the number of funds that were raised on average from 2008 to 2021, it's down about 12% versus last year. So it's getting a little bit tougher, but it's definitely doable. We work with emerging managers all the time that are raising their first funds. You guys do it Vector as well. So definitely there's a lot of people that are able to do it still.
Yeah, we're definitely still seeing a lot of people launching first-time funds. Even the last 6 months, it's been a little bit of a change from last year. We've definitely seen more of an uptick, which is great. So, Tim, you kind of alluded to this earlier when we were talking about trends, but want to talk about kind of the evolving landscape with this. So, how have investor expectations and preferences evolved in recent years, and how does this impact the fundraising process?
Yeah. So we see it specifically from the fund closing space up close and personal. When Ben and Alex started Passthrough, the mere idea of electronic subscription document, that was like a curiosity. We're quickly approaching a world where paper subdocs are going to be anachronistic and gone. So I think what people are expecting, there's just this broader trend of everybody coming in, everybody doing more volume. They're expecting consumer style experiences. And this is largely true of what every fund manager is looking for across all of their stack, because the world's been stuck in something that's 20 years old. And so their expectation is that it's something that it's simple to interact with, their investment into your fund, be it from the subdoc perspective to how their LPs are accessing documents and data and everything else along the way. And what that means is that you need to be able to select vendors that work together, and you need to be able to select vendors that plug into each other. But you still need to be able to handle all of the complexity that's specific to your underlying funds. And so you might have a strategy that says, I'm going to go out and have an onshore and offshore vehicle because I've got investors that I don't want them subject to US taxes. And so it makes sense for me to be in the Cayman. Okay, well, if you need to have that level of complexity, then that means that you might not be able to adopt like this first thing of standardization that we've seen. So that's like the SPV in a box offering, right? And so you need to be able to have a great experience, which we saw this evolution from Assure to AngelList to Carta and to Sidecar on the SPV side of the space that's handling all sorts of different pieces of not just how to actually go make the investment, but the ongoing management of it. To, yes, this works for a very specific use case, but we also need to be able to go handle every ounce of complexity that comes with the fund after that. And so we actually try to fit into that very narrow space. And I know that your team does too, around great experiences that kind of hide the complexity away. So like, our approach to filling out a subdoc, because you only see the questions that are relevant to you, and you see every question that's relevant to you. It doesn't matter how complex that underlying agreement is. And so that same general trend is true. People just need to have it be simple to be able to access data, to be able to go access documents, to be able to go make an investment, see the value of what they own and what it's worth. And it's historically been a very hard thing to do. And I think that expectations were kind of low as a part of that. But as a part of this rush of new investors coming in, as a part of, well, the industry's just growing up and maturing, that's no longer a satisfactory answer. Ben, is there anything that you want to add on that side of things, Ben?
You're still muted, Ben.
I was gonna say that. I think that covers it.
Yeah. No, it's great. I mean, I've known you guys for a while now. I think when the product came out, like, I was shocked that hadn't been a thing before. We always hear the phrase, it's like herding cats, and it legitimately is like herding cats, trying to get people to sign documents, do it on time, fill out the right thing. So it was shocking that there wasn't a product out like yours before. And so I think that has really changed a whole bunch of things on the closing side and even with the process of fundraising and all of that. So, and I've never heard of anyone using a digitized subscription platform and regretting it. So, so it's definitely great. And it's also not only just easier from a fund manager perspective, but it is from a back office perspective too. So say, for example, you're working with Passthrough, but also us, it's going to be a lot more streamlined and a lot faster getting your LPs onto your fund admin's platform from Passthrough than if it were to be just through legal. So that's another thing too. I want to move on to, sorry, go ahead, Tim, if you had anything to add there.
Well, the only thing that I'll add is that, look, like, you have investor expectations about what experiences should be like. And your job is to go meet and exceed their expectations. And we try to be one of the first places that occurs so that you have a fantastic first professional experience with your LPs as they come into your fund. But the investor experience is critical throughout this entire process, whether they're working with a fantastic team like Vector, whether they're filling out a subdoc and it's easy. But I think people also ignore the leverage that they get from modern technology that actually gives them like real insights into what's going on in their fund. It just makes them more efficient fund managers so that they can actually focus on the parts of the business that are higher leverage for them. The reason that people are giving them money is to go out and do the rest of this. And this just gives them
absolutely. Yeah, absolutely. When people come to us and they're saying we're raising our first institutional fund, one of my first things is like, you should go use Passthrough. Like, it's going to make you look good. So, okay, I want to move on to some of the details, specifically around closing now that we're talking more about that. So what are some of the key steps involved in completing a subscription closing for a venture capital fund?
Yeah. So basically the way it works is you're going to get to a point where typically what happens is you'll get some materials prepared, by your attorney. You'll start sending them to folks. And then, once you get enough kind of what's called soft circles, so folks that are kind of informally committed to your fund, if you're running a process, you're going to communicate a date and you're going to send them a subscription agreement to fill out. The subscription agreement typically, what we see, has about 150 questions on it. The reason that there's so many questions is that there's just a whole bunch of different things that are allowed to invest in the United States, and you have to make sure that you understand who your investors are for tax compliance reasons and securities laws reasons. So folks will fill out the subscription agreement, then it needs to be reviewed by counsel. Because the agreement is complex, a lot of times, there's going to be some things that the investor did wrong, and the attorney is going to need to clarify. So there'll be like a change request process. Once that's all done, folks, there'll be kind of a final sign off. For a lot of folks now, and this is kind of a new thing for venture, there's also KYC. So you need to know who your investors are, and you need to make sure that they're legally allowed to transact with you. So that process is just collecting some identity documents, or if they're investing through an entity, some entity formation documents, and then checking them against screening lists. Once all of that's done, the GP acceptance letter is signed by the GP, and that's letting the manager, letting the LPs into your fund, and then a closing email is sent out to the investors that has all of their documents. The last thing. The closing email sent out, and then typically a capital call notice will get sent out by your fund admin after that. So that's the basic kind of breakdown. The thing that we really try to do is simplify all of that. So, there's 150 questions on a subscription agreement on average. If you use something like Passthrough, we get it down to about 30 questions on average that an investor needs to fill out. We were able to reduce the amount of time that folks need to go back and forth with the lawyer, because we kind of solve some of the problems that folks normally run into, and we automate the email process. So we're able to kind of compress the time associated with the process. But those are the core elements of getting folks onboarded and into your fund.
Got it. And then you kind of touched on this a little bit as a sneak peek into next week's session. We'll be talking about KYC AML. It is a newer thing, and I feel like it's still quite unknown. And so we're bringing in some experts from the Passthrough side. So we'll talk about that after. But I do want to touch on, and you did talk about this too, going a little bit off script of what we originally had, but I get a lot of questions of, why can't I just use my legal counsel for this? Like, why can't we just go through DocuSign and use my legal? And then on the other side, Passthrough and their team is always like, no, we work with your legal team. So can you help me understand, and the audience understand a little bit more about how that relationship works? What do you tell investors or fund managers when they're thinking about, do we use Passthrough? Do we use legal? Like, what is the differences?
Yeah, totally. Yeah. So we're a complement to legal team. So we're agnostic about legal provider. Our workflow works with any subscription agreement that law firms use. I think the reason that folks like to use us is, one, you were talking about kind of the appearing professional to your investors. When I started my career in public accounting, the partner I worked for would say, if you go to a mechanic shop and you don't really know what the mechanic did to your car, but you get the car back and there's grease all over your mat, you kind of assume that they didn't do a good job. And so that's kind of one of the reasons why folks use this, is that you look professional, and that reflects on kind of the rest of your fund process. The other thing is we drastically reduce the amount of time it takes for folks to complete subscription agreements. So one of the trends that's happening is that, folks, when I started in alternative investments back in like 2008, maybe somebody would have like a real estate fund if they were high net worth that they invested in, and they invested in one, and so like there wasn't, and now folks, are invested in a whole bunch of funds. And so you have this kind of shopping cart problem where someone may get your subscription agreement and just kind of never fill it out. So you actually want to make sure you send it to them, it takes them 20 minutes to fill it out, they're done. and you can keep the process moving. And so there's like a black hole associated with what happens when you send out someone a subscription agreement. So we track all that. We can show you where they are in the process and make it easy to remind them. And so you want to, there's kind of a higher, especially when capital's tight, there's kind of a higher need to like stay on your investors. And we give you a lot of visibility into that. And so those are really kind of the main reasons. It makes it easier for your investors to get through the process. You get visibility in the fundraising process, and it makes you look professional.
Yeah, and Tim, I didn't know if there's anything you wanted to add to that too.
Well, like we talked earlier about like how do you actually go handle a fundraising process, right? Like you go out and you go spend all this time wooing investors and trying to get them on board. And one of the things that I guess kind of is implicit to that, but you have a bunch of systems in place, be it how you're updating investors on what's going on with your process, how you're tracking it all in the CRM, how you're working with counsel on what to go do on soliciting an investor in this one country in Europe. You have a lot of moving pieces. And so you've invested weeks, months, years in potential investor relationships, and somebody finally says that they're coming on board. You have this last mile problem, which is a very real problem of I said I'm coming into your fund to I'm actually in your fund and I'm giving you money. And what you don't want to do right there is introduce friction. And so the whole point of what we're doing, we do investor onboarding. There's a lot of things that we don't do. We don't do most things. Like we really only make it simple for investors to come into your fund. And so our goal is to plug together all the different systems that you have to connect into whatever providers you're using to make it really simple for you to solve that last mile problem. Because at the end of the day, your goal is to get through fundraising as quickly as possible, because every moment that you're not closed is additional risk that you won't be able to close in the manner in which you want to close.
Yeah, that makes a lot of sense. So you work with both emerging managers, but you also work with a lot of established managers. So how does the closing process differ from the two? Do you see any big differences? Do you see any, challenges, or what does that look like?
Yeah. There's a number of differences between emerging managers and established managers. One is that people might in fact be in different jurisdictions, and different jurisdictions have different requirements, and that might mean working even with a second counsel because you need to go draft something in Israel. It means that you have different groups of people that are coordinating stuff. And so it's not just that your law firm is coming in to review the documents and say this looks good, and then your fund administration team is coming in to extract the documents and the data so that you can quickly get that capital call out. No, you need to get first review by the IR team. Then you need to get counsel to review. Then you need to get tax team to review. Then you need to get somebody else to review. And then somebody needs to review all of the reviews before they actually send something back to an LP. You have an institutional group that needs to have everything reviewed and signed off on before they even go present it to the CIO to go get a signature, because nobody wants to go bug that person for a signature twice. That's how you have a bad day. And so there's all of these different, more complex coordination challenges, first of all, between groups of people, but then second of all, between systems themselves. So, if you're a large established manager, you might be using Salesforce or you might be using DealCloud. And then you've got two separate things for what you're doing on, you're using Alvia for your LP relationships, and you're using DealCloud for your deal work. And then you're making sure that your compliance team is logging into this and this data is flowing into that. And so the thing that you need to solve is coordination and like have a workflow tool that can actually accommodate it. Whereas with a fund manager that's raising like a $50 million fund for the first time based out of Delaware, it's a rather straightforward process. And so the thing that they're looking for is just, how can I really quickly and easily get somebody to fill this out? And they're going to fill it out correctly from scratch. And then I can just collect a signature and move on. There's a much more involved process when I've got 5 different groups of people that have to review and approve things in parallel and in sequence. And then it needs to go plug into everything else that I'm doing. And so I think those are the couple things that I'd highlight.
Yeah, and you mentioned too, talking a little bit about the established manager side. When you work with funds who are more established and maybe some LPs that are, more traditional or want kind of the old school way, how do you approach that when saying, this is a more modern way, this is a tool that you should, potentially be using? How can you show the value of what you're doing to some of these more like old school LPs?
Yeah. One of the original thoughts we had while building this business was there's not just large institutional investors, but frankly, there's people that aren't very comfortable with computers. And so taking people out of this thing that has been the way subscription documents have been done since the dawn of time and moving into an online form is a scary idea. Our hope was that we'd have 75% of investors completing their documents on Passthrough. But it turns out people just hate subdocs. The amount that people detest subdocs is so strong, and we think we've also built quite a good platform, but it's so strong that we have uptake in the mid 90s. And so look, of course, you're always going to get somebody who's going to go fill it out. But the truth is, I think that fear is really overblown. We don't see it in the data. And so look, like when it does happen, great. We can still work with that fund manager to get the data and pass through. One of the real values that we provide is that collection and structuring of data, though. And so that information can be extracted and plugged into whatever systems you want. But it's also because the next time that they come into your fund, this thing that took you 20 minutes the first time takes you 2 minutes the second time. And then you can just move about even quicker. And it just makes it easier for legal, easier for IR, easier for everybody involved.
Yeah. I mean, it's very similar to like the LP portal side of things. It used to be everything went over email, and now LP portal is the industry standard. I think it's the same thing for a digitized subscription, platform. Like that is now the industry standard, which I think is, we're moving in a great direction when it comes to technology. So excited about that. So talking a little bit about some best practices, can you share some for streamlining and optimizing the subscription closing process? And share a little bit about, what you've seen to do that.
Yeah, obviously, we think using our software is fantastic for that. I think that's really big. The other thing is that I've seen that's been, that's been really effective is when folks are doing legal review. And this is something that we work with a lot with attorneys on, is getting back to investors quickly. And so if there is something that they made a mistake on the subdoc, you don't want to wait to review your subdocs, until like a week before you're going to close. What you want to do is make sure that like as things come out, you review, and if something's wrong, you send it back out. That's really important for making sure that you don't have a stressful close. I think we were talking before about like there's between like an institutional close or like an established manager close and an emerging manager close. I would say like one of the other differences is that it's much more stressful for an emerging manager close. You're just it's usually a small team. You're trying to get everyone in. You haven't had these investors actually like sign anything in the past. And so you want to make it as kind of smooth as it can be for you. And part of that is just kind of getting up in front and making sure that if someone signed it, it's that subdocs are being reviewed as they come in.
Yeah, I guess keeping it moving along probably is one of the best practice pieces. And that's what I love about the Passthrough platform too, is that you can see where everyone's at. If someone's stuck, and then ask questions in the portal so that you're addressing those quickly, getting that moving along, because obviously everything's on a timeline, so you got to close. So and Tim, was there anything that you wanted to add in terms of best practices when it comes to the closing process?
I think that kind of covers it. I mean, like, you be speedy, be professional. That's about it.
Yeah. And I guess lastly, just to wrap up this side, and to talk a little bit more about the Passthrough tool, but can you share more about how specifically it does streamline? I know I touched on a couple points, but share about how it does streamline and optimize the entire closing process.
Sure. I'll hold off on KYC for a moment because I think we'll talk about that with the team next week. The core problem is related to getting subscription documents executed. First of all, the data isn't structured. So you've got data that sits in your CRM, you've got data that sits in past subdocs, you've got data that sits in a bunch of different places. You can't get it in, you can't get it out, you can't reuse it in the system. Then you have this, well, what's actually going on with my investors in the process? And so You send out a subdoc over email. Good luck actually understanding what's going on. But okay, finally they do surprise you and they come back with the subdoc. Then it's, well, I need to get my lawyer on the same page as I do my fund admin. I'm going to have to email them for updates 3 times a day as I'm getting closer to close. And so people are on not the same page. And then in the investor experience, these 150 questionnaires are designed to be quite broad. And so the 30 of the questions that apply to you means that you're going to answer the wrong thing. You're going to miss things you're supposed to answer. You do it all over again from scratch. And so what the Passthrough platform does, we take it, we build out a custom workflow exact to your underlying agreement. We work with you and counsel to make sure that it's completely to your specifications. And then you invite your investors. You can see where your investors are in the process. They come back. You and your counsel are on the same page. You review it. You say it looks good. You countersign it. The closing set volumes get shared automatically. All the documents and data can be extracted into whatever your systems. And like I said, first time through, it's an investment of 20 minutes from your LP. Second time through, it's confirm, 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 and sign. And so what we do is just make it very quick, very simple, very efficient to collect new commitments.
Sounds pretty easy. So, and then just in a couple of minutes, we're going to go through some questions in the audience, but I did want to ask one last thing. And this relates to the state of fundraising report that you did. What was and for both of you, what was the most interesting thing that you learned doing that survey? Or is there not something that you were surprised about? Were you expecting everything?
I was surprised on the secondaries side. I was surprised that maybe not that there was as much demand, but perhaps that was it. That there was significant demand, but also that half of the GPs we surveyed were actually providing liquidity to their LPs, be it for end-of-life funds or whatever personal reasons. That was kind of surprising. Like the whole thing about private equity is you have the illiquidity premium. And so like all of a sudden we've got some liquidity in there. And I do think it's a sign of the changing times where there's a segment of investors that are coming into the space that are not used to having a 14-year investment. And so it's putting some pressure on how these products actually work. That I think was my most surprising takeaway.
Interesting. And Ben, what about you?
I was the thing was I was surprised by and it's a good thing. I was just surprised by how many folks thought they were going to be able to still hit their investment their fundraising goals, which is great news. So that's good. I would have thought that that folks had shifted their goals a little bit, but no, it seems like folks still think they can do it.
Yeah, I think those are both 2 really interesting points. And after this, I briefly looked at it, but I'm going to read into it more deeply. I think it's definitely an interesting report to take a look at. So anyone has any questions, go ahead and put them in the question section, bottom right-hand screen. I know we have a couple already, so I'll start going through them. And then if we run out of time or if we have anything else we want to cover, we can do that. But first question is where can we find these Passthrough articles? So I will share a link to download both the State of Fundraising report and the Emerging Manager Guide in the follow-up email. Definitely check both of them out. They're going to be fantastic resources. I love the Emerging Manager Guide too, because we collabed on there and we have a interview with our COO, Christina Dayback, in there, which is pretty interesting. And then second question. So regarding adding placement agents to the team for VC fundraising, our attorney in Silicon Valley recommended strongly against this due to negative signaling value to LPs, i.e. managers having a hard time raising. How do we square this with more VC managers actually contracting with placement agents?
The placement agent stigma is a actual stigma. Like that's absolutely the case. The way that we're hearing about people deploying this is strategically though, right? So the thing that people get concerned about with the placement agent is, it means I'm having a hard time raising, or that the placement agent going out is just going to spam a bunch of people that they don't really have relationships with, or effectively like the LPs that I want, if they ever got an email from a placement agent, they would never answer it if their life depended on it. In fact, they would cross me off there. I'm never going to invest in this fund list. So all of those things can be true, but placement agents still can also be a valuable thing when deployed correctly. So like one example of this, let's pretend that you believe that there is a really interesting opportunity in Latin America. You want to be able to bring in investors from Brazil. You don't have relationships in Brazil. You don't speak Portuguese. And so the thing that you could do is find a reputable placement agent that is fluent and native in Brazil, has native fluency in Brazil, and also has a significant track record of the kinds of investors that you want. And so when you have something like that, this is just all about exposure to the right audience. And so in that case, when you see people that are really embarking on a placement agent strategy, sometimes they'll have, one or two, because I'm trying to get exposure to institutional investors, and there's this one specific placement agent that has a really fantastic network with institutional investors that I want to talk to in my space. And okay, great. Sometimes it's, I've got somebody for Brazil, I've got somebody for Singapore or the greater Pan-Asian region. There's a million different ways that people can cut it up. But I think the clearest cut one is really around geography. People try not to have too many placement agents because it's just yet another relationship that you need to balance. And sometimes they'll have relationships where they'll have multiple placement agents within the same firm, but they have different focuses on it. And so this isn't, full-throated recommendation of everybody needs to go get a placement agent today. In fact, I give no recommendations on whether or not to use a placement agent, but it's that placement agents, when used strategically, can be an effective tool to augment your fundraising efforts.
Yeah, I mean, that's definitely something too you spoke about earlier. Just, it's a new trend. It's a newer thing that people are doing, or one of the things people are doing to try to get the challenges with the fundraising environment. So that's pretty interesting. So what do you see? Or actually, let me go back. Is Passthrough planning to integrate with fund admin platform or accounting software so that the process is more streamlined for LPs or managers?
Yeah. So we're working with a lot of folks on that. Yeah. So that's our core strategy.
Awesome. Well, that'll be great for us too, which is super exciting. So what do you see as kind of the standard timeline right now for fundraising? And what do you tell fund managers when they're wondering, like, how long should we be fundraising for? When do we hold a closing? Should we close sooner than we thought we were gonna? What are you seeing that now with kind of the current state of things?
Yeah, that's a great question. We actually should have good data on that, but I don't have it offhand. We should know. I will say this, like anecdotally, what I've seen for folks is that they are closing their funds earlier, which means, if you're trying to raise a $50 million fund, you're not waiting until you get to 25 million to do your first close. You're waiting until you get to 10 million, 15 million, something like that. In real estate, like where I was working before, the rule of thumb was you didn't want to close with less than 50. In venture, it doesn't work like that. Folks close, at a much smaller amount. One of the nice things about it is that if you have a year-long fundraising, and you close, you make some investments that are good. Venture moves pretty quick, and so at the end, your investors are coming in, and you already have some stuff marked up, so it makes it easier to fundraise down the line.
Got it. Tim, anything else to add into that?
It's so individualized. I mean, like Ben's right on the more frequent closes. But beyond that, for some managers, it's going to be something that takes them a while. And for some managers, it's going to be something that takes them really quickly. The general trend is that it's taking a little bit longer than people previously expected, and some people are in market a little bit quicker. But yeah, it's such an individualized thing. It's hard to paint with a really broad brush.
So we have a question about pricing. So the question is, how does the pricing model work for emerging managers? And then assuming like plain vanilla Delaware fund, how do you guys typically look at pricing when it comes to the closing process?
Well, we have partner pricing in place with Vector, so that's a good place to start. So essentially the way it works is you're either using us for fund closing and or KYC AML. So for fund closing, if you're in the market all the time, then it's going to be an annual fee, and it's not going to be something that breaks your bank. Like relative to your overall closing cost, we're not the largest part. We're far from it. We're actually likely going to save you money rather than be something that is like an additional item for you. Like this is going to make it easier. And then for KYC, it's just the number of investors that you're on, and it's a per investor fee. So yeah, that's the basics. Again, probably want to talk specifics.
Yeah, we can definitely, if you want to reach out after, we could talk more about specifics. And then as Tim said, we do get a very nice Vector special partner discount. So if you use us for fund admin, it's always a benefit on that. I wanted to touch on one more thing about the fundraising side of things. And I know that you work with also open-ended funds. So I'm just curious to know, are there any differences in the state of fundraising between the closed-ended market versus open-ended market right now?
So the survey was really focused on closed-ended funds. So I don't have the data at hand. Everything that I have is just what we hear from our customers and partners in the space. The narrative was basically that it was very difficult to go have a new fund launch over the last couple of years in the hedge space, especially in 2022, even more so than it was in the closed-ended space. It was really shut down for them. But it's pretty tied to what's going on in the markets, and so I don't have any additional data to be able to show. But I suspect with the current thawing of the markets that it's not quite as dire as it was a year ago. But again, I don't have the data to back it up.
Yeah, and I won't hold you to anything that you say here, but what is your opinion, or what do you think the future is going to be? What do you think 2024 is going to look like for, fundraising, just from what you've been seeing and then the current survey that you have? And it could be totally an opinion. I'm curious to know.
All right. Ben, do you want to weigh in on this one first? I'm trying to fit.
What do I think is going to happen? I don't. There's a joke I like. There's a bond trader who gets hit by a car, dies and goes to heaven, and when he gets there, God asks, "Hey, what do you think interest rates are going to look like next year?" It's hard to say. Like who knows?
Yeah.
I largely agree. Otherwise, I wouldn't be building a company. I would be trading instead. So
fair point. Okay, so I know we only have a couple minutes left. I just want to ask a couple things about Passthrough specifically too. So how does your product compare to some of the other ones in the market, some of your competitors? Because we get a lot of questions. We obviously have a partnership with you, but we get people coming in, they're saying, hey, we're looking at this one, we're looking at this. They think it kind of looks the same on the surface, but when they actually go to use it, there are a lot of differences. So I'm curious to know how you compare to your competitors.
Yeah.
Oh, sorry, Tim, you can go.
Okay. So first of all, it's the easiest way for investors to go fill out a subdoc completely, right? Like it is impossible to be confused by what to answer because you will only ever see the questions that are appropriate for you and for nothing else. And so the efficiency of getting somebody to fill something out quickly and correctly, it's kind of like bar none. Second is that the only thing that we do is investor onboarding. And by the way, that's the only thing we're going to do. So you don't have to be worried that one day we're going to go sell you an investor portal and have a feature that you'd really like for an investor portal that is only, or for fund closing, it's only tied to the investor portal. It's just not going to happen. Speed is a pretty big deal. So we have a team that's in the US that onboards and customizes your subscription agreements and does it within 7 business days and gets it exactly to the degree of specification that you'd like. So if you need to go fundraise in a week and a half, we'll have subdocs ready for you. That is unmatched.
Yeah.
I think if you talk to our customers and you talk to certainly our partners, they'll be able to tell you about our customer service too. And I saw there was somebody who just asked what's the difference between Passthrough and vanilla. Well, so vanilla is a good piece of software if you're a Cooley client. A number of Cooley lawyers like using it. It's really built for vanilla though. Like it's built for the Cooley docs. We're flexible to any other requirement that you have. And so if something changes on the fly, Passthrough is not going to break. We can just go make the tweaks. I'm non-technical. So far as our team goes, I'm very on the non-technical end. I can go in and update your subdoc. That's how easy this system is, so that we can move at the speed that you want, but also handle every degree of complexity that you have to. And even the most standard VC funds have complexity.
Mm-hmm. I mean, that's why we love working with you. It's very easy to use, even for our team too on the back end. So when we're using that information to onboard into our system. I'll touch on one more question and then we'll wrap things up. So will I lose access to previously collected subdocs?
No.
Okay. So do you keep all that information for like a certain amount of time? Is it forever? What does that look like?
So we might technically have a policy somewhere that says it's 7 years or something like that. But the idea is that these are your documents, it's your data, you can grab it. And so it'll be there.
Fantastic. All right. So, or I guess we got one more question. So how does Vector and Passthrough work together? I could touch on it if you want to touch on it. Whatever works best. Yeah. So we are partners with Passthrough. Basically what happens is we will be part of the closing process, just overseeing everything. So we do get involved kind of at the beginning of that. We'll oversee the process. So if there are questions that we can help answer, we do that. At the end of the closing process, so once KYC AML is done, once you've countersigned, we will directly work with the Passthrough team to onboard your investor information into our system, Valence. And so what the benefit of that is, one, it's incredibly fast. So say, for example, you're closing and you have to call capital pretty much right away. It's going to be like 1 to 2 business days to get everything set up in our system and ready to call capital. Whereas traditionally, if you do it through like legal or DocuSign, it's going to take somewhere from like a week plus to even get that information in, because you're manually going through all of the data. And so we are working directly with that team. We have a person who's our point of contact that we work with on all of our engagement, Pam. She's incredible. And so it's a really streamlined process. Going back to the whole institutional thing, it just looks really great. It's good, easy for your investors. And so that's kind of how the whole process works. But so I want to wrap it up. So that's all the time that we have. If you do have any more questions for Ben or Tim or even me, I'll send around a follow-up with our contacts. You can connect us after the webinar. As I mentioned at the beginning, we do have another session next week. So that's part 2 of the Passthrough webinar. And we're going to be talking about KYC AML. That's going to be with Passthrough's Chief Legal and Compliance Officer, their financial crimes analyst, and one of their product managers. And that'll be next Wednesday, same time. I want to thank you again, Ben and Tim, for joining. This has been awesome. And thank you everyone else for joining. You'll receive a follow-up with the links after this with everything that I mentioned. And then, yeah, we'll see you next time.